If you wake up at 7 in the morning, spend an hour getting to work, work 8 hours, and then spend another hour getting home, you have given roughly 10 hours of your day to earning money. That is what most people do. They work, they commute, they answer messages, they handle pressure, they trade energy, time, and attention for income. Then the money they work so hard to earn sits in a bank account earning almost nothing. In other words, the person is working all day, but the money is sleeping. That is an important imbalance to understand. If you are always working for money, but your money is not working for you, then you are living inside a system where your labor carries the entire load that is not sustainable for most people over a long enough period of time. I do not say that dramatically, I say it mechanically. When one side of a system is active and the other side is idle, the active side gets exhausted. That is true in a business. It is true in an economy, it is true in a household, and it is true in a personal financial life. So the goal is not to day trade, it is not to chase hot stocks, it is not to sit in front of a screen all day pretending that movement is intelligence. The goal is much simpler. You want to create a system where your money begins to work while you are living your life. I want to use a very simple milestone to explain this. $10,000 is not financial freedom. It will not change your entire life in one day, but it is enough money to build a structure. It is enough money to feel what it means to have capital. It is enough money to stop thinking only like a worker and start thinking like an allocator. That shift matters. A person who only thinks like a worker asks, how do I earn more this week? A person who starts thinking like an allocator asks, where should this dollar sit so that it has the best chance of becoming more dollars over time? Those are very different questions. When you learn to allocate, you begin to understand that money is not just something you spend or save. Money is a tool. It has a job. And if you do not give it a job, inflation will give it one for you. The job inflation gives your cash is simple. Lose purchasing power slowly enough that most people do not notice until years have passed. That is why leaving money idle can feel safe while quietly being unsafe. It gives you emotional comfort today and structural weakness tomorrow. A good allocation system should not feel like gambling. It should not make you check your phone every 10 minutes. It should not make your stomach tighten when the market moves. If your investment plan keeps you awake at night, that is not a plan, that is stress with a ticker symbol attached to it. A proper plan should feel more like setting a washing machine. You choose the cycle. You load the clothes, you hit start, then you let the machine do its work. You do not open the lid every 3 minutes and ask whether the shirt is clean yet. That is the mistake most people make with investing. They start something that needs time, then judge it every day as if it were supposed to produce instant results. So let me ask the practical question. If you had $10,000 today, what would you do with it? Would you lock it in a fixed deposit? Would you buy an insurance savings product? Would you leave it in a checking account because at least it feels safe? Many people do exactly that. They work hard for years. They sacrifice, they save. Then the money sits there earning a few dollars of interest while the cost of living keeps rising. It is like carrying water up a mountain with a hole in the bucket. You are doing the work, but the system is leaking value. Before I explain the allocation, we have to break 3 myths. These myths are simple, common, and expensive. The first myth is that investing is dangerous and saving is safe. That sounds logical, it feels logical. You can see the cash in the account. The balance does not swing every day. There is no red number staring at you, but safety is not just the absence of volatility. Safety is the preservation of real purchasing power. If inflation is around 3.3% and your deposit earns around 1.9%, your money is losing about 1.4% of its real value each year. You may still have the same number of dollars, but those dollars buy less. Over 10 years, that difference matters. $10,000 that appears stable can lose real purchasing power until it behaves more like $8,700. That is not safety, that is slow erosion. It is important to understand this because many people confuse nominal stability with real stability. The number on the screen stays flat, so they believe nothing is happening. But something is happening, the denominator is changing. Prices are changing, the real value of the money is changing in a system where the cost of living rises. Idle cash is not neutral, it is a position. And that position has consequences. The second myth is that you need a lot of money to begin investing. Many people believe that unless they have hundreds of thousands of dollars, there is no point. That belief keeps them frozen. They wait for a future version of themselves who has more money, more confidence, more knowledge, and more perfect timing. But wealth does not begin when you are rich. Wealth begins when you build the habit and the system. $10,000 is a meaningful starting line because it is large enough to structure, but small enough that most disciplined people can eventually reach it. It is the point where money stops being only an emergency cushion and begins becoming a base. This is like going to the gym. You do not refuse to train because the dumbbells are not heavy enough. You start with the weight you can control, you learn form, you repeat, then the system gets stronger. Money works the same way. The first goal is not to impress anyone, it is to get the form right. The third myth is that investing means staring at charts and doing endless research. If you are a professional investor, yes, you may spend your life studying businesses, cycles, markets, and incentives. But for most people with normal jobs, families, and limited attention, that is not the best path. Your time is valuable, your attention is limited, and the market is larger than you are. One of the most useful things a person can do is admit that the market is usually smarter than their impulses. That does not mean you are helpless. It means you should design a system that does not require you to make brilliant predictions. That is what passive investing is built around. Do not try to beat every participant in the system every day. Own broad pieces of the system. Let businesses work. Let compounding work. Let time do the part that human emotion is bad at doing. This is not exciting. But many important things are not exciting. A strong foundation is not exciting. Insurance is not exciting. Proper risk management is not exciting. But when stress arrives, boring things are often what keep you alive. That is why I emphasize $10,000. Not because it makes you wealthy, because it changes the way you relate to money. At a 6% annual return, $10,000 can generate about $600 a year. That is about $50 a month. $50 a month will not pay for your life. It may not even pay for much of your monthly budget, but it is not earned by your labor. It is produced by capital. That distinction is psychologically powerful. The first time you see money appear in your account because your assets produced it, something changes. You begin to understand passive income not as a slogan, but as a mechanism. It is a small fruit from a small tree. But once you see the fruit, you begin to understand why planting matters. That feeling matters because it can shift your relationship with work. Work is still important. Income is still important. Human capital is still usually the biggest asset a person has. But once your money begins producing even a small amount of income, you stop seeing money only as something you earn and spend. You begin seeing it as something that can reproduce. That is when the game changes. The problem is that most people never build a system. They watch one video and buy one stock. They hear a friend mention one fund and copy it. They see a market drop and freeze. They see a market rally and chase. That is not investing, that is reacting. And reacting is usually expensive. A person who wants to get healthy does not run 10 miles once and then do nothing for 3 months. Health comes from repeatable behavior. Wealth is similar. It is built by a system you can keep following when you are tired, when headlines are scary, and when you are tempted to do something clever. So here is a simple allocation system for $10,000. I think of it in 3 layers. The first layer is the safety net. The second layer is the growth engine. The third layer is the opportunity fund. Each one has a job. That is the key. Money without a job becomes emotional. Money with a job becomes part of a system. The safety net is 20% or $2,000. This money is not for investing. That is important. Its job is not to grow fast. Its job is to protect the rest of the plan. It should sit in a high-yield savings account, a reliable cash account, a short-term deposit, or something similarly liquid and safe. The point is that it must be available when life creates a problem, a pipe bursts, the car needs a repair, a job is lost, a medical bill arrives. Life does not ask whether the market is down before it sends you an emergency. That is why a safety net matters. Many people fail at investing not because they choose the wrong fund, but because they are forced to sell at the wrong time. They invest everything, feel proud, and then an emergency arrives. Because they have no cash buffer, they sell assets during stress, sometimes at a loss. That is not a market problem, that is a liquidity problem. Liquidity is what allows you to stay in the game. I have learned that staying in the game matters more than almost anything else. If you get knocked out by one emergency, it does not matter how good the investment plan looked on paper. The safety net is the part of the system that lets the growth engine stay untouched. It is not wasted money. It is psychological security and strategic flexibility. The second layer is the growth engine. This is 60% or $6,000. This is the core of the allocation. Its job is long-term growth. This is where the money is sent to work. A reasonable way to think about this layer is a mix of broad stock ETFs and bond ETFs, for example. 70% of this growth engine can go into broad stock market exposure, such as a total market ETF or an SP 500 style ETF. These represent ownership in large parts of the economy. You are not betting on one company. You are participating in the productive system. The remaining 30% can go into bond ETFs or investment-grade bonds. Bonds are not as exciting as stocks. They generally do not grow as much over time, but they provide stability, income, and balance. Stocks are the part that seeks growth. Bonds are the part that reduces the emotional and financial shock of volatility. When these two are combined, the portfolio becomes easier to live with. That matters. The best theoretical portfolio is useless if you cannot hold it when it falls. Risk is not only volatility on a chart. Risk is also the chance that your emotions force you to abandon the plan at the worst possible moment. A 100% stock portfolio might look better in a spreadsheet for some people over very long periods. But if that person panics during a 30% drop, then the spreadsheet lied about the real risk. The right portfolio is the one you can actually hold. For many people, a stock and bond mix is not weakness, it is design. Now, timing, do not obsess over buying the perfect day. The desire to find the bottom is one of the most destructive impulses in investing. It feels intelligent, but it often becomes paralysis. Even professional investors struggle to time markets consistently. And if professionals with teams, models, and data cannot reliably do it, a normal person with a full-time job should be careful pretending they can. A better method is dollar cost averaging. Take the $6,000 and divide it over 6 months. Invest $1,000 each month. If the market goes up, you participate. If it goes down, you buy at lower prices. If it moves sideways, you keep building. This removes the need for emotional prediction. You do not need to be right about the exact day. You need to keep moving money into the system over time. That is a more durable principle. The third layer is the opportunity fund. This is the final 20% or $2,000. This money is flexible. It is there for clear market weakness. Its job is to give you bullets when other people are panicking. My way of thinking about this is simple. If the broad market drops more than about 15% from its peak, that is the kind of environment where opportunity begins to appear. Not because every dip is safe, not because falling prices cannot fall further, but because long-term assets become more attractive when fear creates discounts. The opportunity fund should not sit completely idle if you can avoid it. It can sit in a money market fund, short-term ETF, or similar instrument that earns modest interest while staying available. But the purpose is not the 2% or 3% return. The purpose is optionality. Optionality is valuable. When markets fall, the person with no cash can only watch. The person with cash can act. That difference changes psychology. During market declines, many people are forced into defense. They check their accounts. They feel fear. They wonder whether they should sell. But if you already built an opportunity fund, the same decline can create a different reaction. You still feel discomfort because you are human. But you also know you prepared for this. You have a plan for deploying in batches. That reduces panic. A good system turns chaos into a set of actions. This is not about being aggressive for the sake of aggression. It is about being prepared. Markets move in cycles. They expand, contract, recover, and expand. Again, the exact timing is unknowable. The pattern is not new. The system does not require you to predict the cycle. It requires you to behave well inside the cycle. That is the real point. Now let us move from the allocation to execution, because a plan that cannot be executed is just a thought. The first step is to open a brokerage account. This is much simpler than it used to be. Most major platforms allow a person to open an account online with identification and bank details. The important things to look for are reliability, low fees, broad ETF access, and an interface you can understand. Do not overcomplicate the broker choice. A good enough broker today is better than a perfect broker never chosen. The second step is to set up automatic transfers. This is crucial. Human nature is not designed for perfect discipline. People get busy, they forget, they hesitate. They wait for the right time. They find reasons to delay. Automation is how you remove some of your own weakness from the system. If a set amount moves from your checking account to your investment account automatically, you no longer have to negotiate with yourself every month. The money moves, the plan continues. Your emotions are not invited to every decision. That is powerful. The third step is to choose the ETFs. If you do not know what to choose, the simplest approach is broad market exposure. A total market ETF or a fund that tracks the S&P 500 can be enough as a starting point. There is no perfect fund, there is no magic product, there is only a suitable structure aligned with your goals, time horizon, risk tolerance, and behavior. Many investors waste months comparing small differences that will matter less than simply starting. Action matters. The fourth step is rebalancing. Rebalancing means returning the portfolio to the intended allocation after market movement changes it. Suppose you begin with 70% stocks and 30% bonds in the growth engine. If stocks rise faster, the mix may become 80% stocks and 20% bonds. At that point, you sell some of what has gone up and buy some of what has lagged, returning to 70 divided by 30. Emotionally, this feels strange. People want to keep buying what has been winning, But rebalancing forces discipline. It makes you sell relatively high and buy relatively low. I would not rebalance every day. That creates noise. A simple 6-month schedule can be enough for many people. The point is not precision. The point is discipline. The fifth step is to keep learning without overreacting. Investing is a lifelong education. You should understand markets, inflation, interest rates, economic cycles, and how your own behavior affects your returns. But learning is not the same as tinkering. There is a big difference between being informed and being reactive. Many retail investors underperform broad market indexes because they trade too often, chase what just went up, and sell what temporarily went down. They believe activity creates control. Often it creates cost. The best investment strategy for most people is usually boring. Buy, hold, rebalance, repeat. It does not sound sophisticated, but principles do not need to sound impressive to be effective. Now let us talk about returns. A 70 divided by 30 stock and bond portfolio has historically produced long-term annualized returns around 6 to 8% depending on the period, the exact assets, and inflation. That range is not guaranteed. Nothing in markets is guaranteed, but it gives us a framework. If $10,000 compounds at 7% annually, it grows to nearly $20,000 in 10 years. In 20 years, it grows to more than $38,000. In 30 years, it grows to more than $76,000. That is without adding another dollar. But most people do not only invest once. If after investing the first $10,000 you add $200 per month and let the system compound for 30 years, the account can grow to more than $300,000 under those same assumptions. That is what compounding does. It turns consistency into scale. At first, the growth looks slow. This is where people get discouraged. They see small changes and believe the plan is not working. But compounding is not linear. It is curved. The early years look quiet because the base is small. Later, the same percentage return acts on a much larger base. That is why time is so important. A 7% return on $10,000 is $700. A 7% return on $300,000, same return, different base, different result. This is why the first stage feels frustrating. You are building the base, you are not yet seeing the full force of the system. Most people quit during the base building stage. They want proof before the proof is mathematically visible. That is a behavioral problem, not a math problem. You have to know in advance that the early years will feel unimpressive. That knowledge protects you from abandoning the process. You will also experience market crashes. That is not a possibility. It is part of the system. Markets fall. Sometimes sharply. Sometimes for reasons that are obvious, sometimes for reasons that are not. In the middle of the decline, it will feel like something is broken. That is when you need to remember that volatility is the price of higher long-term returns. During the pandemic crash in 2020, accounts fell quickly. A 30% decline does not feel academic when it is your money. It feels personal, it feels like danger. But if your allocation includes a safety net, bonds, and an opportunity fund, you do not have to make a panic decision. You can let the system guide you. This is why design matters before the crisis. You cannot build emotional stability in the middle of the fire. You have to build the system before the fire begins. Your biggest enemy in investing is usually not the market. It is your own reaction to the market. That is true in many areas of life. Pain creates urgency. Urgency creates poor decisions. Poor decisions create larger losses than the original pain required. A system exists to slow that process down. When the market falls, the system says what to do. Do not sell from fear. Keep buying if your long-term thesis is intact. Use opportunity cash if the decline meets your rules. Rebalance if the allocation has drifted. Stay liquid enough that you are never forced to sell. These are principles. They are simple. But simplicity is not the same as ease. The difficulty is emotional execution. Now there is another important point. Your investment return is not your only source of wealth. Your human capital may be your biggest asset if you are 30 years old and earn $60,000 a year until age 65. That is more than $2 million of lifetime labor income before even counting raises. Your skills, discipline, career path, network, and ability to solve problems are major assets. So do not become so obsessed with portfolio yield that you neglect the machine producing the income that funds the portfolio. Invest in yourself. Learn skills, build competence, increase your earning power. A higher income allows larger contributions. Larger contributions increase the base. A larger base allows compounding to work harder. This is how the system accelerates. Imagine two people begin with $10,000. One invests it well but never grows income. The other invests it well and increases income from $60,000 to $120,000 over several years. The second person can invest far more each year. The compounding base grows faster. The system becomes more powerful. Income and investing are not separate. They reinforce each other. Your labor creates capital. Capital creates optionality. Optionality creates better choices. Better choices create a more resilient life. That is the loop you want. Let us summarize the practical system. Take the $10,000 and give it jobs. $2,000 goes to the safety net. $6,000 goes to the growth engine. $2,000 goes to opportunity cash. The safety net protects the system. The growth engine builds the system. The opportunity fund strengthens the system during fear. Then automate contributions. Use broad, low-cost ETFs. Rebalance every 6 months. Keep learning, but do not overreact. Continue increasing your income. Keep the system simple enough that you can follow it when life gets busy. This strategy will not make you rich overnight. It is not supposed to. Anything promising overnight wealth usually contains a hidden risk the seller is not emphasizing. The purpose of this strategy is to create a durable path. $10,000 can become $20,000, then $38,000, then $76,000. And with continued monthly contributions, it can become hundreds of thousands. Not because you predicted every market turn, not because you found the perfect stock, not because you were smarter than everyone else, because you built a system and stayed with it. That is how most real wealth is built. Slowly at first, then more quickly, then suddenly in a way that outsiders call luck. But it was not luck. It was the result of repeated decisions under a stable set of principles. The danger is waiting until you feel ready. Most people never feel ready. There is always a reason to wait. Rates might change, markets might fall, inflation might rise, politics might shift. The news will always contain uncertainty, but uncertainty is not an excuse for inaction. It is the normal condition of life. If you leave money in the bank forever because you are waiting for a perfectly safe moment, inflation keeps moving, time keeps moving, the market keeps moving, and your opportunity to let compounding work keeps getting shorter. The best time to start was years ago. The next best time is when you can start with discipline. That does not mean rushing blindly. It means taking a deliberate first step. Open the account. Set the transfer, choose a simple broad fund, hold the cash buffer, create the rules, then let time begin doing what time does. There will be fear at the beginning. That is normal. Putting hard-earned money into markets can feel uncomfortable. But after the structure is in place and you see the process working, the fear often becomes less powerful. You begin to trust the system, not because the market never falls, but because you know what you will do when it does. That is the point of financial management. It is not only about getting rich, it is about buying choices. The choice to stop panicking over small emergencies, the choice to stay calm when markets shake, the choice to let your money work while you work on your life. The choice to build a future that is not completely dependent on trading 10 hours a day for income forever. That is why $10,000 matters. It is a starting point for a different relationship with money. If your money is sleeping while you are working, wake it up, give it a job, give it a structure, give it time. And if you do that long enough, the version of you 10 years from now will look back and understand that the most important part was not the amount. It was the decision to begin.